much is this?
I have no earthly idea. How much is enough? How big does this pile have to be?
Hey guys, Rob here from the Endgame Investor, and today we're going to talk about what might be going on in the banking system, how it might reflect the endgame in terms of monetary realities. Let's talk about the interplay between asset prices and consumer prices and how they affect each other and what it means when one is going up, the other going down, both are going up, both are going down, etc. My contention at this point is the following. Bank balance sheets are filled to the gills and they cannot take any more assets because they have run out of balance sheet space. Now, what do I mean by that? Well, if a bank takes on an asset, let's say $1, then it has a liability to pay back that dollar to the depositor of that dollar plus interest. And therefore, taking on $1 costs money. In order for stock prices to rise, a bank must be able to take on more dollars, or the banking system in general must be able to absorb more dollars with which to fund the payments of the purchase of equities or bonds or whatever asset prices. If more money cannot be stuffed into the banking system, then the prices of assets, be they stocks or bonds or whatever paper that is dollar denominated, cannot rise any further on net. Now, what is the situation now? The situation as we see it now is that reverse repos keep rising and rising and rising, meaning extra dollars that are not part of the banking system keep going up and up and up. There is a reason that they are continually being stuffed into reverse repos, meaning money loaned back to the Fed rather than staying on the balance sheet of the banks where those deposits exist, because it costs banks money to hold deposits on their balance sheet, because all the assets that they hold on the asset side of their balance sheet are also liabilities that they must pay back. So if they have extra dollars that they cannot loan out and they have to pay interest on those dollars to depositors, it makes more sense for them to deposit those dollars back into the Federal Reserve System, which we see as reverse repos in the chart ahead. This is the all-time chart of all reverse repos that have ever been in this system. You can see they are practically zero until we get to 2014, which was the advent of QE3. And here you see that they're spiking at the quarterly ends here. But ever since 2021, which is about 1 year post the COVID money printing bonanza crazy insanity, see them going vertical and they will not stop going up. Why are there 2 point whatever, 2, 3, 4, whatever trillion dollars in reverse repos of money at the Federal Reserve that keep rising and rising and rising? The simple answer is that there is nowhere to put them, because if they put them in deposits, they have to pay interest on those deposits, and that interest, and considering the rate of inflation of about 8.5% on the CPI, which is a lie, they are going to lose money if they hold that dollar balance on their balance sheet. And so they give it back to the Fed. Nor can they loan it out, because the interest rate at which they should be able to loan it out, which is about 3.1% on the 10-year, is way below the inflation rate. So why the hell would a bank loan out money at 3.1% interest if they are losing 8.5% interest just through inflation, or the price inflation rate? The answer is they wouldn't. So there's nothing they can do with this money other than send it back to the Fed for some nominal interest basis points, and that's it. And therefore, what I'm saying is that the money supply, the M2 money supply, which is now contracting on a quarterly basis, cannot rise no matter how much money the Fed prints. Because if you think about it, the Fed prints more money in a complete reversal of quantitative tightening, which supposedly they're doing now, which is not what they're actually doing. If they reverse stance and start printing more money, where is it going to go? How can it go into the economy if you can only loan it out at rates way below the rate of inflation? It is not worth it. And so all the extra money they would print in the next printing round will simply go back into reverse repos until the point when interest rates rise above, substantially above, to compensate for risk. The rate of price inflation, which is currently 8.5%. And so interest rates would have to rise to about 10, 12, maybe even 15% in order to incentivize banks to loan out their extra deposits at interest. And that would expand the money supply. But I believe at this point, it is impossible for the money supply to expand, given that interest rates are much lower than the rate of inflation. There is no incentive for banks to expand the money supply through loaning, which is what the fractional reserve system is based on. Therefore, what I am saying is that asset prices should continue to deflate from here. And now what happens when asset prices deflate? Well, imagine you were a middle-class guy or gal with a portfolio of stocks and bonds or whatever, and you see that value moving every day, every week, every month, or however often you check it. And you know what your grocery bill is and it's rising, your gas bill is and it's rising, but let's say that your portfolio is rising in tandem. So what do you care about your consumer bill? What do you care about your food bill and your gas bill, as long as your assets are rising in dollar terms at the same or faster rate, your purchasing power is maintained and everything is fine. So you do not panic and hoard. However, if asset prices are falling and your consumer prices keep rising, your standard of living will fall. And once you see that asset prices are not rising and they continue falling faster and faster, you will take them out of assets, stocks, and bonds, or whatever they may be, and you will plow them into consumer prices in an attempt to get ahead of the price inflationary pressures. That is ultimately what leads to hyperinflation. Now take a look at this. This is from the book, The Economics of Inflation. We see here wholesale prices in dollars, which is gold, because this is a chart from 1922, just prior to the Weimar hyperinflation. The cost of living in the second line over here, it says cost of living, and prices of stocks. So you see consumer prices here and gold prices, which are dollar exchange, because the dollar was gold back then. The cost of living rises exponentially. The cost of gold, or the price of gold, rises even faster than that. So those who own real money increase in their purchasing power, and the prices of stocks, paper assets, stocks and bonds increase, but not nearly as fast as the cost of living. This is what's going to happen in the hyperinflation, the upcoming hyperinflation of the dollar instead of the German mark. And now we can see this mathematically in the total market cap of stocks and bonds versus the money supply. The total size of the US bond market as of 2021, the latest numbers I could find, is $119 trillion in debt outstanding. The total size of the US stock market is $48 trillion. Combine that, compare it to the amount of dollars in the US money supply in the M2 measurement, and that is 21.75 trillion as of last week. The leverage ratio is therefore 667%. So if they do not want asset prices to collapse, they will have to keep printing dollars until they equal or exceed the amount of the total market cap of US bond and stock markets. But that will end up increasing consumer prices much faster than they will end up increasing asset prices, and you will have more and more chasing of consumer prices because people will try to get in front of the price inflation, whereas asset prices may rise, but they will rise much slower, just as they did during the Weimar hyperinflation. And so we get to the next bullet point. As the central bank prints more money to keep assets, stocks, and bonds inflated, consumer prices rise faster and catch up. Next bullet point, consumers can no longer rely on assets to keep up with cost of living. They sell and buy consumer goods instead. The money substitute then dies as existing debt cannot be serviced. And so as bank balance sheets are full, they are completely leveraged, and the load was blown during the COVID money printing bonanza. There is no more room for banks to profitably hold any more dollars because they cannot loan them out at any rate that is profitable for them to do so. So therefore, on that basis, asset prices should stay static to falling here, and consumer prices should continue to rise until the public chases after consumer prices to get in front of them, and asset prices continue to fall because people are selling off their stock portfolios in order to chase food and energy and all their basic necessities. So why are reverse repos rising 2.2 trillion and continue to rise? Because there's nowhere else to put this money, and therefore the next round of printing, when the Fed pivots, it will probably all go into reverse repos also, because it will lower interest rates even farther below the current CPI inflation rate, there will be nowhere for banks to loan their money profitably, and you will continue to see consumer prices rise and rise and rise until the dollar is dead. In the meantime, the only assets to run to are real money, gold and silver, some non-monetary commodities. Bitcoin is dead, stocks and bonds are static, and it is time for the endgame scenario to kick in earnest in the next few weeks to months. This is Rafi of the Endgame Investor. If you enjoyed this analysis, sign up for a 2-week free trial of the Endgame Investor, where I discuss these ideas in detail, or become my patron on Patreon for as little as $3 a month, where I give a weekly commentary on the portion of the Torah read by Jews every week of the current situation from texts that are very old. See you guys in the next few days.
I gotta do it, man.
Ah, screw it.